Audio and video clear, everyone? Can you please confirm? Is audio and video clear to everyone? Come on, guys. Come on, tell me. Wonderful. Thanks, Aman. So today we'll be discussing a few important questions that I've identified from the around 12 past papers. Okay, we'll be discussing those questions. Along with that, we will be discussing one question of group P&L from the pre-mock June 24 exams. Okay, so we'll discuss the group P&L. Why group P&L? Because the examining team has mentioned that group P&L is important from an exam perspective, and group P&L is the weak area of the students. Okay, so that's the reason we will be discussing the one question of group account. So I'll be solving that group P&L in ACCA practice platform with all of you. Okay, I'll be solving it here in ACCA practice platform so that you get to know how exactly to use ACCA practice platform. Plus, you also get to know that how exactly you have to solve a question on group P&L and what are the mistakes which you can do, but you have to avoid those mistakes. Okay. Now there are multiple queries going on in the Telegram group and in the WhatsApp group, also in the personal messages also. Sir, when will you do SBR revisions, my dear friends? So 22, 23, 24 is for FR. 25, 26, 27 is for SBR. Okay. So for SBR students, I'll be coming up with a session on 25, 26 and 27. Don't worry at all about that. Okay, now, so let us start the discussion of important questions of financial reporting paper. Okay. Now, so these questions I have picked from examiner reports. So let us discuss these questions. September, December 23, there is no such question. Now coming to June 2023. Coming to March, June 2023. So this is the question. So let's read the question. Understand the requirement and solve the question and find the appropriate or correct answer for the same. Babar Company acquired 60% of Randit Company on 1st April 2006. Okay. On that date, the carrying amount of the Randit Company's net assets equaled the fair value except for the property. Okay, except for the property. The properties have a carrying amount of this much. Property had a carrying amount of this much and fair value of this much. Now, what is the excess fair value? Tell me. What is the excess fair value? What is the excess fair value or fair value adjustment? What is the fair value adjustment that has to be done? It is 3.2 million minus 1.8 million. 3.2 minus 1.8 is 1.4 million. So that is 1.4 million. So this is the excess of fair value. This which has a remaining life of 50 years. Okay, this is the only property within the Babar group. What is the impact of fair value adjustment? What is the impact of fair value adjustment? Impact of fair value adjustment on the Babar company's group retained earnings. Group's retained earnings. What is the impact of it? Okay, now understand. So fair value adjustment we do on date of acquisition, right? Fair value adjustment we do it on date of acquisition and in the post period. Now, whatever fair value adjustment which we do on date of acquisition, will it impact group retained earnings in any manner? Tell me yes or no. Whatever adjustment that we do on the date of acquisition, will that impact group retained earnings? No. Why? Because whatever adjustments that we do on date of acquisition to the net assets of subsidiary, that is used for the calculation of either goodwill or gain on bargain purchase Okay. Now, whatever adjustment that we do in the post acquisition period has an impact on group retained earnings and non-controlling interest. Now we have to find what is the adjustment that we have to do in the post period. So in the post period, the impact will be remaining life is 50 years. When we acquired 1st April X6, what is the year end? 31st March 2007 means post acquisition is 1 year. So the post acquisition adjustment will be this much multiplied by 1 by 50. Now, So this is the adjustment in the post acquisition period. Now what is the impact in group retained earnings? The holding percentage 60%. So what is the amount into 0.6 is 16,800. 16,800 is the answer. Is that clear, everyone? Is that clear, everyone? Tell me, guys, come on. Okay, now coming to the next question. See, this is what I have already solved it here also for you guys. So I'll be sharing this file after the class. I'll be sharing this file with you, all of you, after the class. Okay, don't worry. Now coming to September, December 2022. Saguaro company acquired 25% equity shares in Cactus. 25%. If nothing is mentioned, it is what? If nothing is mentioned, what will we presume it to be? It is presumed to be an associate. It is presumed to be an associate. Associate means what? More than 20 or more, but up to 50. 20 or more up to 50. Okay, is called as an associate. Is called as an associate. Okay, so now this will be an associate. Now, so what is the question asking for? What is the question asking for? What is the carrying amount of investment in associate? What is the carrying amount of investment in associate? Okay, guys, you are watching this video and not liking. Is it fair? Tell me. Come on, guys. Come on. All of you. Come on. Like this video, fatafat. And show some energy in the class. Come on, all of you. Hit the like button. All of you, hit the like button. Okay, now, so it says Saguaro company acquired 25% of the Cactus, means it's an associate. For how much? For 400,000. So this is the cost. This means 400,000 is the cost. On 1st March 20x1. On 1st July 20x1, Cactus paid a dividend of 36,000. Cactus profit for the year end 31st December 20x1 is 115,200. All the profits accrued evenly over the year. All the profits are accrued evenly over the year. So what will you do? Cost of investment plus post acquisition share of profit minus post acquisition share of dividend will give you the value of investment in associate. So cost of investment is how much? Cost of investment is how much? 400,000. Dividend paid is how much? 36,000. But what is the dividend that I have received? Cactus has paid a dividend of 36,000. But what I have received? 36,000 ka 25% is 9,000 is the dividend that I have received. Okay. Now profit is how much? 115,200. But what is my share of profit? What is my share of profit? So 115,200 multiplied by 25%, that is 28. Okay, 115,200. Okay, this is for okay. So we have acquired the subsidiary on what date? 1st March. We have acquired the subsidiary on what date? 1st March. The year end is 31st December. So we will take from March to December. Means we have to exclude January and February. So means we have to take it for 10 months. So 115,200 multiplied by 10 divided by 12 into how much percentage? 25%. It comes to 24,000. So 400,000 plus 24,000 minus 9,000 is 415,000. This is the value of carrying amount of investment in associate that will be recognized in group SOFP. That will be recognized in group SOFP. Okay, now again, wonderful question. Again, a wonderful question. Okay, though a very easy question, this one which I'm discussing right now, March, June 2023, but a very easy question. But almost all the students would have made a mistake in the exam if they would have if they will see this question for the first time in the exam. Now, read the question. Pearl Company has controlled an 80% owned subsidiary. Controlled an 80% owned subsidiary. Is it saying 80% control? No, it says controlled an 80% owned subsidiary. Controlled a subsidiary in which I have 80% ownership. Okay, Silver Company for many years. Silver Company sold goods to Pearl Company, means subsidiary has sold the goods to parent. Okay, for 120,000 with a markup of 20%. Now tell me, what is the meaning of markup? We have discussed it yesterday. We have discussed this yesterday. What is the meaning of markup? Tell me, guys. Markup is on cost. Markup is on cost. So now whenever it is markup given, what you have to do? 20 by 120. 20 by 120 to calculate unrealized profit. Okay. Now Pearl company has sold half of these goods by the year end. What is the question asking for? Which of the following statement regarding intra-group transactions in the console FS are true or false? Which one is true and which one is false? Revenue must be reduced by itna. Cost of sales must be reduced by itna. Non-controlling interest must be reduced by itna. So let us understand what exactly is the true and what exactly is false. Let us understand that. Okay. Now, how much revenue should be reduced? Tell me. What is the intra-group transaction? 120,000. So we will reduce my revenue by 120,000. So this is true. So this is true. This is true. Now, cost of sales must be reduced by 110. We have to see cost of sales definitely should be reduced by 120,000. But we will add unrealized profit. Now, what is the amount of unrealized profit? What is the amount of unrealized profit? So 120,000 is the amount of intra-group sales. Half of these goods have been sold. Means half of these goods is still in the inventory. So half is still in the inventory, multiplied by 20 by 120. So 10,000 is the unrealized profit. So 10,000 is the unrealized profit. 10,000 is the unrealized profit. So cost of sales must be reduced by 110. It is true. Now non-controlling interest must be reduced by 2,000. Okay, fine. So now this unrealized profit of 10,000 will be recognized where? In the post profit, in the post acquisition. In the post acquisition, tell me yes or no. Who has sold first of sales? See, silver company. So subsidiary has sold to parent, right? So it will be recognized in the post acquisition period. Now post acquisition period, whatever gets recognized gets transferred to parent and to NCI in the ratio of their holding. What is the ratio of holding? 20%, 80% and 20%. 80% is for parent, 20% is for NCI. So NCI will get reduced by 2,000. 10,000 ka 20% is 2,000. So NCI will get reduced by 2,000. It is true. So all of them are true. All of them are true. All of them are true. Is that clear, everyone? Come on, guys, tell me. Is that clear, everyone? Are you understanding, guys? Next, again, a wonderful question. A wonderful question. Alpha company acquired 80%. Please listen to the question carefully. Acquired 80% of the ordinary share capital of Bravo. Okay, so it means 80% is the ownership of the subsidiary. Okay, on 1st September 2004, and 40% of Charlie company means what does it mean? What does it mean? Alpha company is the parent. Okay, Bravo company I have acquired 80%, but it is my subsidiary with 80% ownership. Okay, Charlie company is my associate with 40% ownership. So this is the what the question says as of now. Okay, now subsidiary company we have acquired on 1st September 20x4. Now what is the year end? What is the year end? What is the year end? So year end is 31st December 20x4. So means subsidiary company we have to do time adjustment. Now what is the question asking for? What is the profit attributable to equity shareholders of Alpha? Now this is what I have told you in the last class also. This is what I have told you in the last class also, that whenever the question asks for what is the amount attributable to the parent company, then what you have to do? First of all, calculate the total profit. Then calculate what is attributable to NCI. Then whatever is the balancing figure is the profit attributable to the owners of the parent company, shareholders of the parent company. So what is the total profit? First of all, tell me what is the total profit. So total profit is first of all 80,200. 80,200 is the full profit. Okay, first of all 80,200 is the full amount of profit. Parent fully it will come. Now Bravo company 51,900 we have acquired on what date? On 1st September. Year end is what? 31st December. September, October, November, December. 4 months. So 51,900 multiplied by 4 by 12. Multiplied by 4 by 12. Now here it says Alpha company sold the goods to Bravo at a profit of 2,000. Okay, means Alpha company has done an intra-group transaction with Bravo for 2000. Half of these items remained in inventory at year end. Means this, out of this profit, half of this profit is unrealized. So minus 1000, not here. This minus 1000 should be done here ideally. It should be done here because Alpha company has sold the goods, right? So Alpha company has realized the profit. So we have to reduce the profits of Alpha company. So we reduce the profit of Alpha company. This is this one. Now, what about Charlie? 86,800. Did we acquire it in this year? No. It was acquired several years ago. Charlie company was acquired a number of years ago. So what is the holding of Charlie company? 40%. So let's take 40% of 86,800. So what is the amount? So total console profit is 131,220. Total console profit is 131,220. Now, when the question asks what is the amount of profit attributable to the equity shareholders of Alpha company, you know what is the mistake which the student will do? Okay, sir, and NCI is 20%, parent is 80%. So now what they will do is, they will say, sir, 80% is for parent and 20% is for NCI. Tell me, is that correct? Tell me, is that correct? No, that is not correct. But this is a mistake which ideally you could have done. Okay, this is the mistake which you could have done, but I don't want you to repeat this mistake in the exam. Come on, all of you, please promise me. Will you repeat this mistake in the exam? Will you do this mistake in the exam? Please, come on, tell me. Okay, now, so what will you do? First of all, calculate the profit attributable to NCI. And how to calculate the profit attributable to NCI? Take the profits of subsidiary. 51,900 is the profit of subsidiary. Okay, 4 by 12 multiplied by 20%. Since there are no such adjustments which impacts the profit of subsidiary company, right? So 51,900 multiplied by 4 by 12 multiplied 20%. This is the amount attributable to NCI. This is the amount attributable to NCI. Now, then what is the amount attributable to the parent? So what is the total profit minus amount attributable to the parent NCI? This gives the amount attributable to the owners of the parent company. 127760. 127760. Are you understanding it, guys? Come on, tell me. Are you understanding it? Now, March, June 2021. Again, a wonderful question. Though an easy one, but an important one. Though an easy question, but an important question. March, June 2021. Platinum Company acquired 80% of the ordinary share capital of Palladium Company on 1st April 2020 by means of cash and contingent consideration. At this date, Platinum Company assessed the fair value of contingent consideration at 250,000. Okay. Platinum Company calculates non-controlling interest using the fair value at the date of acquisition, which is estimated to be this much. Goodwill is this much. So now understand what is happening in the question. Question is giving you the fair value of contingent consideration. Question is giving you, the fair value of contingent consideration. Though again, the question is telling you that I have also paid cash, but this is not available with me. Fair value of contingent consideration is available with you. The question is telling the fair value of NCI is also available with you. The value of goodwill is also available with you. Okay. Now the value of net assets is also available. How come? See, on date of acquisition, share capital is 500. Retained earnings on 1st January is 300, so minus 300. Now, profit is 120, but for the entire year. But we have acquired on when? 1st April 2020. So out of 120, we have to take 3 months profit in the date of acquisition. So that comes to 30. So what is the amount of net assets? The amount of net assets is 500 minus 300 plus 30 is 230. So the net assets is also given. So now understand what is the question asking for. What is the cash consideration? So that's a balancing figure. See, understand. Investments cash balance is what you have to find. This is what you have to find. Okay. This is what you have to find. Fair value of contingent consideration is given in the question. Fair value of NCI is given in the question. Fair value of net assets is given in the question. Goodwill is given in the question. Now, can you find this one? So it is very simple. Goodwill is 300 plus 230 minus 100 minus 250 is 180 so we have to do back calculation. You have to do back calculation and you will find the value of cash as the balancing figure. Is that clear, everyone? Again a wonderful question, but yes, you could have stuck upon if अगर आपने ये वाला क्वेश्चन पहले नहीं देखा होता तो माइट भी एग्जाम में आप फंस सकते थे यहाँ पे. ठीक है, चलो again question, again a good one. Indicate by clicking on the relevant boxes in the table whether following statements are true or false in relation to the accounting of acquisition of subsidiary. When a parent company is satisfied that there has been a gain on bargain purchase, that is negative goodwill, it should be recognized in consolidated statement of P&L immediately. True. We have discussed it yesterday, right? Negative goodwill. Why false? Vishnupriya? True, right? True. When I am satisfied, okay, the gain on bargain purchase is correct, so it should be recognized in P&L immediately as other income. Now, if the liabilities of the acquired entity are overstated, if the liability is overstated, then the goodwill will also be overstated. Okay, if the liability is overstated, then net assets will be understated. Tell me. If the liability is overstated, then the net assets is understated, and if net assets are less, goodwill will be more. Why? Understand. I'll tell you how. Let's suppose investments is 100. Okay, net assets is 80. So goodwill comes 20. Now, if the liabilities are overstated, net assets will be understated. So what will be, let's suppose, if the net assets become 75. If the net assets become 75, then goodwill becomes what? 25. Means if the net assets is less, goodwill is more. So this is also true. Is that clear? Everyone? Is this question clear to everyone? Now, again a wonderful question. September, December 2020. Patter Company acquired 80% of the issued equity share capital of Sono Company on 1st May 20x1 when the balance on the Sono Company's retained earnings was 520,000. On 15th November 20x8, Sono Company made 240,000 sales of goods to Patter Company, on which Sono Company made a markup of 20%. Patter Company subsequently sold one quarter of these goods to external parties prior to 31st December 2008. At 31st December 2008, the retained earnings of Patter Company and Sono Company were 4 million and 3.4 million respectively. What is the question asking for now? What retained earnings should be repeated in the consolidated statement of financial position? Basically, it is asking for the balance of Group RE. The question is asking you the balance of Group retained earnings. That's all. So let's calculate that. So what is the date of acquisition? 1st May 20x1 is the date of acquisition. Okay. Now, then it says when the retained earnings was 520,000. Then on 15th of November, Sono Company made the sales to Patter Company. Means who has sold to whom? Subsidiary has sold the goods to parent company. Now, what is the sales? 240,000. What is the profit? Markup means on cost. So into 20 by 120. Now how much is sold? Sold 1 quarter, means 3 quarter is still in the inventory. So 3 quarter. So what is the unrealized profit? 30,000. How come? 240,000 into 20 by 120 into 3 by 4 is 30,000 is the unrealized profit. Now what is the retained earnings for at the end of the year? 4 million and 3.4 million. So what is the Group RE? First of all, let's take the entire balance of parent as it is. Now for subsidiary, let's take what is the movement. What is the movement from 520 to 3.4? So 3400 minus 520 is the amount of profit made during the year, out of which 30 is the amount of unrealized profit. Since this unrealized profit was subsidiary to parent, I will adjust it here. Had this been parent to subsidiary, I will not adjust it here. I will not adjust it here. Rather, I will adjust it separately here. Rather, I will adjust it separately here. I will adjust it separately here. Okay. So multiplied by 80% is this much. So this is the amount of profit. Group retained earnings 6280 is the amount of group retained earnings 6280. I believe that is very much clear to all of you. I believe it is clear to all of you. And these type of questions are really good, though they are not something out of the box. They are normal, easy questions. But yes, if this type of questions comes in the exam for the first time, you are seeing this question for the first time, you might get confused. Okay, so that's why I'm discussing these questions with you. Now, two associate companies. Okay, identify out of these groups, you have to identify one associate company from this group and one associate company from this group. You have to identify one associate company from each of these. So let us understand. Acquisition of 10% Artels of Zakal company has no representation. Zakal company has no representation on the board. Tell me, where is has no representation on the board? Is it a associate? No, it is not an associate. It is not an associate. No, it is not an associate. Now, acquisition of 40% of Bandoka due to an agreement with the other shareholders, Zakal company effectively holds 52% of the voting rights. Okay, understand what is happening. Though I have voting rights of to the tune of, acquisition to ownership to the tune of 40%, but I have voting rights to the tune of 52%. Means there is a control. So is it an associate? No, this is also not an associate. Acquisition of 50% of Caster company has appointed 2 of the 5 directors. 2 of 5. Can 2 of 5 take decisions? No. But can they participate? Yes. So this is an associate. So here in associate 1, you write Caster company. Okay. Now in group 2, acquisition of 21% Dunanten company. However, the other 79% is held by Yenti, a company with no links to Zakal. Not sure. It can be an associate by the presumption approach. It can be an associate, but not sure. Nothing is specified. So let's read another. So I am not able to say either fully yes or either fully no. I am doubtful. So let's keep a question mark here. Acquisition of 70% of Ihan company, Zakal company has been appointed to direct the operating policy. So this is clear no, this is clear no, this is clear no, because 70% presumes control. Okay, and direct the operating policies means decision making power. So control is there. Now, acquisition of 15% of the Furnit company, Zakal company can appoint 1 of the 5 board of members. Now, this question is making it clear that you have the right to appoint 1 director in the board of directors. So this is an associate. So the answer is Furnit company. Answer is Furnit company. Is that clear, everyone? Tell me. Is that clear, everyone? March 2020, Root company acquired 30% of the 100,000 equity shares of Branch for $7.5 per share on 1st January 2007, when Branch company has a retained earnings of 460,000 and a balance on revaluation surplus of 50,000. At the year end, 30% means presumed is, it is presumed, since nothing is specified others, so we'll presume it to be an associate. Okay, now for 7.5 per share, retained earnings of this much, revaluation surplus of this much. At year end, retained earnings is this much, revaluation surplus is this much. considered its investment in branch has suffered an impairment loss of this much. What is the question asking for? The question is asking what is the carrying amount of investment in console SOFP. Console SOFP, basically it is asking for what is the investment in associate in group FS, investment in associate as per equity method, So applying the equity method, you have to take the cost of investment plus the profit earned minus the dividend paid minus unrealized profit only and only if parent has sold to associate, minus impairment losses. Since there is no unrealized profit in this case, so let's take the cost of investment is 30,000 into 7.5 is the cost of investment. Okay, now then retained earnings was 460 at the time of acquisition, at year end is 370. So what is the change? 370 minus 460 का 30%, negative 27,000. Revaluation surplus was 50,000 and then 70,000. So what is the change? 70,000 minus 50,000 का 30% is 6,000. Impairment loss is how much? 40,000. So will we multiply impairment loss by 30%? No, my dear friends. Impairment loss you are not required to multiply with 30%. Impairment loss you are not required to multiply with 30%. No. Just give me a minute. This is a mistake which you can make. So what I'm doing is I'm writing in a piece of paper and I will add it to your mistakes tracker and I will share that file with you. Okay. Impairment loss on associate. No multiply percentage. Now, July 2020. Green company acquired 70% of the blue company on 1st January 20x4. At 31st December 20x4, the equity of both the companies was as follows. Okay. Now, green company, blue company. Share capital is this much, retained earnings is this much, total is this much. So acquired what? 70% on 1st January 20x4. Okay. Year end is what? 31st December 20x4. Okay, now what is the question saying? On date of acquisition, the fair value of net assets. Fair value of net assets is 40 million. Goodwill is 25 million. Okay, 20% of goodwill is to be impaired. Non-controlling interest at fair value. What is the amount should be shown in console RE in the statement of financial position? Console RE at 31st December 20x4. Okay, now what will be the first of all? Take the entire amount of parents RE, that is 116. Entire amount of parents RE. Now, what is the change in the RE of the subsidiary from date of acquisition till now? Okay, so on date of acquisition, it was fair value of net assets on date of acquisition was 40 million. 40 million. Now, what is the net assets? 50 million. So 50 minus 40 is 10. 10 is the change. Now multiplied by 70% is 7. Okay. Now what is the goodwill impairment? Goodwill impairment is goodwill is 25 impaired by 20%. Goodwill is 25 impaired by 20%. Now since NCI is at fair value, goodwill impairment has to be allocated to parent and NCI in the ratio of their holding. So 70% multiplied 3.5. So the answer is 119.5. The answer is 119.50. I hope it is clear to all of you. Now, so these are the questions which I have identified from the past papers, but now there are some other questions which I have identified, okay, and which I believe are important for today's discussion. There are some other important questions also which I have identified for you guys, okay. So now tell me, are you enjoying the session? मजा आ रहा है क्या? Come on, tell me. Are you enjoying the session? Are you learning from the session? Is the session helpful? Come on guys, tell me. Wonderful. Chalo, let us discuss further. स्टूडेंट ऑफ दिस क्लास का अवार्ड विष्णुप्रिया को जाएगा, क्योंकि विष्णुप्रिया के अलावा कोई स्टूडेंट्स एक्टिव नहीं है आज. हर्षिता, आप आज एक्टिव नहीं हो? Okay, on 1st July 20x7, स्पाइडर कंपनी अक्वायर्ड, स्पाइडर कंपनी अक्वायर्ड, मैंने बोला था ना कल इन द लास्ट क्लास आई टोल्ड दैट क्वेश्चन नंबर 269 ऑफ बीपीपी बुक यू हैव टू सॉल्व फॉर इंट्रा ग्रुप लोन्स. आई एम हियर विद दैट क्वेश्चन. I am here with that question. Okay, to question number 269 from BPP material on intra-group loans. This is the question which I will tell you in almost every batch. I take up this question for at least 3 to 4 times. Okay, so please, this is the most important question, and I can guarantee that if these questions would have come in the exam for the first time, you would have definitely made a mistake in the exam. So let's read and understand the question. On 1st July 2007, Spider Company, just give me a minute. 1 minute guys, please. Spider Company acquired 60% of the equity share capital of Fly Company on that date, made 10 million loan to Fly Company at the rate of 8% per annum. At the rate of 8% per annum. What will be the effect on group retained earnings at year end date of 31st December 2007 when this intra group transaction is cancelled? See, understand, in this question what is happening? Spider Company, okay, I have drawn the chart. Please look in this chart, look into this chart and make yourself comfortable. Year starting is from 1st January 2007, ending on 31st December 2007. Okay, date of acquisition is 1st July 2007. Okay, how much you have acquired? 60% you have acquired. Okay, I will be explaining this question in depth, so please understand it off. Okay, how much you have acquired? 60%. Who is giving the loans to whom? Parent is giving the loan to subsidiary. See, and they, on that date, made a loan of 10 million to Fly. Spider has given to Fly, parent has given to subsidiary. Okay, loan of 10 million at a rate of 8%. Loan of 10 million at a rate of 8%. Now tell me, first of all, what is the journal entry or what is the finance income or finance costs which parent and subsidiary would have recorded in their separate financial statements? So in the separate financial statements of parent would have recognized finance income of what amount? 10 million into 8% into 1st July 31st December is 6 months. So 6 by 12 is 1 by 2 is 0.4 million finance income parent would have recognized and 0.4 million finance cost subsidiary would have recognized. Tell me, is it clear to everyone till here? Is it clear to everyone till here? Okay, now what will happen in group FS? What will happen in group FS? So in the group FS, I have to reduce the profits of parent. I have to reduce the profit of parent. So what I will do? I will debit group RE. I will debit group RE. I will debit group RE. Okay, now I have to reduce the cost of subsidiary. I have to reduce the costs of subsidiary, meaning thereby I have to increase the profit of subsidiary. I have to increase the profits of subsidiary, right? So I will do two post acquisition profits of subsidiary. I'm increasing the profits of subsidiary by 0.4 million, 0.4 million. Tell me, is this entry clear to everyone till here? Is this entry clear to everyone till here? Now, tell me, whatever we record in post acquisition profits gets transferred to two places, group RE and NCI, in the ratio of holding. Whatever we recognize in post acquisition profits, gets transferred to two places, group RE and NCI, right? So we will transfer to group RE 0.24 and to NCI 0.16. Now then what will be the revised entry? So the revised entry will become group RE 0.4 million, 0.4 million similar. Now this one we have transferred to group RE 0.24 to NCI 0.16. Now what will happen? This one will get knocked off with this one. So what is the final journal entry? The final journal entry will become group RE to NCI 0.16 to group RE to NCI 0.16. Now what is the question asking for? What is the effect on group retained earnings? So what is the effect on group retained earnings? So group retained earnings will decrease by 0.16, will decrease by 0.16, will decrease by 0.16, will decrease by 0.16. This is the answer. This is the answer. Tell me guys, is that clear to everyone? Is that clear to everyone? Come on guys, tell me. Is this question clear to everyone? Wonderful. Now, again, a wonderful question. Again, a wonderful question. Again, a wonderful question. Okay. Now, boat company acquired 60% of the anchor company on 1st January 20x4. Okay. I am going back to this question. Vishnu Priya is telling me to repeat. Okay, Vishnu Priya, understand. Understand. Parent would have recognized. Parent would have recognized. Parent subsidiary group. Parent would have recognized a finance income of 400. Okay, and subsidiary would have recognized a finance costs of 400. Tell me yes or no. Now, in group, in group, in group FS, tell me what will you do? In group FS, what will you do? What will you do? You will reverse this. You will reverse this. Tell me yes or no. Now, what is the entry for reversal? Reversal means you will reduce group RE by 400. Tell me, is that clear, everyone? Okay. Now, in group, again, you will reverse this as well. In group, you will reverse this as well. Right? So now, what is the impact? You will increase post acquisition profits by 400. Right? Now, if anything is recognized in post acquisition profits, if anything gets recognized in post acquisition profits, it gets transferred to group RE and NCI in the ratio of their holding. So group RE you will increase by how much? 240. NCI you will increase by how much? 160. Tell me yes or no. Tell me yes or no. Now, so what is happening? See now. Here you are reducing the group RE by 400. Here you are increasing the group RE by 240. So net what is happening? Net what is happening? Net what is happening? Net group RE is first of all increasing by 400, decreasing by 240 means net. Okay, sorry, sorry, my bad. Reducing by 400, increasing by 240 means net decreasing by 160. Now is it clear? Now is that clear, Vishnu Priya? Okay, proceeding further. So it says Boat Company acquired 60% of Anchor Company on 1st January 2004. At the date of acquisition, the carrying amount of Anchor net assets were same at the fair values, with an exception of item of plant and machinery, which had a carrying amount of this much and a fair value of this much. Means a fair value adjustment of 70,000 has to be done. Remaining useful life of this is remaining useful life of this is 5 years. Non-controlling interest are valued at fair value. What is a journal entry to reflect the fair value adjustment as on 31st December 2006? What is the date of acquisition, guys? Come on. What is the date of acquisition? What is the date of acquisition? 1st January 2004. So it's been X4, X5, X6. It's been 3 years since we acquired the company. Now let us see this flow chart. On date of acquisition, we would have recorded fair value adjustment of 70,000. Tell me yes or no. On date of acquisition, we will record 70,000 fair value adjustment. Subsequently, in the post period, we will record excess depreciation for the 3 years, which will be 70,000 into 3 by 5, that is 42,000. Tell me yes or no. This 42,000 will be transferred to parent group RE and NCI, because anything which gets recognized in post acquisition, anything which gets recognized in the post acquisition gets transferred to group RE and NCI in the ratio of their holding. So we will transfer 42,000 to group RE and NCI in the ratio of their holding, that is this much, right? So what are journal entries? Date of anything which gets recognized on date of acquisition is adjusted with goodwill. Now, if you are increasing your net assets by 70,000, if you are increasing your net assets by 70,000, your goodwill will decrease by 70,000. Yes or no? Yes or no? The more is the value of net assets, the less is the value of goodwill. The less is the value of goodwill, because while calculating goodwill, we reduce net assets. The more amount we reduce, the less amount of goodwill we will get. The less amount of goodwill we will get. Guys, is the video quality okay to all? Is the video quality okay to all? Everyone, come on, tell me. Is the quality of video okay? Wonderful. Take it. Now, so what will happen is we will pass entry PPE account debit to goodwill 70,000 because we have increased the value of net assets. So value of goodwill will decrease. Now, this one 42,000, definitely this 42,000 excess depreciation we are charging depreciation. So it will reduce the value of net assets. It will reduce the value of PP. It will reduce the value of PP, plus will take the impact to group RE and NCI. So these are the two journal entries. Now what you have to do, you have to combine these two entries. You have to combine these two entries. So when you combine these two entries, it becomes what? Group RE account debit, NCI account debit. See, group RE account debit 25,200, NCI account debit 16,800. Now goodwill 70,000, goodwill 70,000. Now PP 42,000, PP 70,000. So the net amount is 28,000 PP here. So this is the answer. This is the answer. Now you have to come here, and this is the answer. Group RE for 25,200, NCI this much. Property, plant and equipment this much, and credit goodwill 70,000. So this is the answer. See, A is the answer. First is the answer. Is that clear, everyone? Is that clear, everyone? Is this question clear to everyone? Come on, guys, tell me. First of all, confirm, and then I'll proceed further. Wonderful. Next question. Now I think two more questions remaining here. Yes, two more questions, that's all. Then we'll move to console P&L from pre-mock exam. Ulysses company owns 25% of the grant company. Owns 25% of the grant company, which it purchased on 1st May 2008. Okay. So let me highlight the figures. 25%, again, it means what? We will presume it to be an associate. Okay, on 1st May 20x8 for 5 million. So this 5 million is the cost. 1st May 2008 is the date of acquisition, 5 million is the cost. At that date, grant company has a retained earnings of 7.4 million. At year end date, the grant has a retained earnings of this much after paying out a dividend of 1 million. So this the movement which will come will be net of dividend. The movement will be net of dividend. Okay. Now on 30th September 2008, grant company sold. Wonderful. This was the point which I wanted to explain you, and this is coming up here. So a wonderful point. Just give me a minute. Okay, this is the point why I have taken this question. This is the point why I have taken up this question. This is the point why I have taken up this question. Okay, now let us discuss it. So what is the question asking for? The question asking what is the amount of investment in associate in the console SOFP on 31st October 2008. So how will you calculate? What is the cost of investment? What is the cost of investment? 5 million. What is the cost of investment? 5 million. Now what is the movement in retained earnings? So it's a post acquisition profit net of dividend. If the question gives you profit and dividend separately, then you have to add profit, reduce dividend. But since the movement was net of dividend, so I recorded it net of dividend. So 8.5 million minus 7.4 million ka our share is 25%, comes to 275,000. Okay, add this one. Now understand, grant company has sold the goods to Ulysses. Grant company has sold the goods to Ulysses, means associate has sold the goods to parent. Associate has sold the goods to parent. Now tell me, who has earned the profit? Who has earned the profit? Associate company. So where will the where is the adjustment? Where will the adjustment go? Share of profit of associate. Share of profit of associate. Now who has the inventory? Parent. Who has the inventory? Parent. So we will reduce inventory to pay inventory to inventory. Now tell me, will this impact my investment in associate in any case? Will this impact my investment in associate? Will this impact my investment in associate? No, my dear friend. No. Okay, so that's why. See, I have written an unrealized profit, but I have striked it off. Why? Because it will not. But had this been a parent to associate case, if this is the case, no, you will not recognize, it will not impact my investments figure. But if this is the case, then yes, it will impact my investment in associate figure. Be very careful. Be very careful in the exam. Be very careful in the exam. Be very careful in the exam. If it's parent to associate, then only we will impact the investment associate. If you can recall, I told this in the last class as well. I will show it to you. Just give me a minute. Associates. If it is associate to parent, if it is associate to parent, okay, I have told it here. If it is associate to parent, it will impact inventory, it will impact group retained earnings. Okay, but if it is parent to associate, if it is parent to associate, then it will be the case of investment in associate. Then we will impact investment in associate. Okay, Vishnu Priya, please watch the yesterday's lecture, this part where I've explained this part in depth. Okay. Now, so basically I will again, if considering the point, I'm repeating it again. If parent is selling to associate, if parent sells to associate, so in console P&L, what will you do? If parent sells to associate, you will add the unrealized profit. You will add unrealized profit to cost of sales. That's all. In console SOFP, what will you do? If parent, so it will be RE account debit to investment in associate, because associate has the inventory, and we are not recording the investment inventory of associate in our console SOFP. But if it is associate to parent, then what in the CPL, what we will do in the CPL, what we will do is we will reduce share of profit in SOFP. What I will do, I will reduce again associate. So I will reduce post acquisition account debit to inventory, because parent has the inventory. Now in this case, what is happening? Associate has sold the goods to parent. Associate, grant company is the associate, has sold the goods to parent. Associate has sold to parent. So it will impact the group, it will impact the post acquisition profits of associate and inventory. It will in no manner impact investment in associate. Yes, Vishnu Priya, please tell me your doubt. Okay, fine. Now moving on to the next question. If you can recall, in the last class I was telling about Pandar company, right? So the crux of Pandar company I have taken up here, the intra-group loans part of Pandar company, which was the most important part of Pandar company, most complex part of Pandar company, I have taken up here, and I will discuss that with you. Okay, now, so in the Pandar company, it says the parent has recorded a finance cost of 1800 and subsidiary has recorded a finance cost of 3000. Parent has acquired 80% of subsidiary. On what date? On 1st April 20x9. And on the same date, parent has given a loan of $50,000 to subsidiary at an rate of 8% per annum. Question is asking, what is the consolidated finance cost? What is the finance cost to be recognized in group P&L? What is the finance cost to be recognized in group P&L? Okay, now, so understand, first of all, let us calculate what is the post acquisition finance costs of subsidiary company. So understand, first of all, year starts from 1st October x8, year ends on 30th September x9. Subsidiary was acquired on 1st April 20x9. Okay, now question is telling you that for the entire year the finance cost is 3000. Okay, now question says out of this 3000, one part of this 3000 is only for this one. So in this date the loan is taken. Subsidiary company has taken a loan from parent company. Parent company has given a loan to subsidiary company, for which the finance cost is how much? 50,000 is the loan amount. 8% is the entire this one multiplied by 6 by 12. So what is the finance cost of 2000? So out of 3000, the question is saying one component of 2000 is entirely post. Now can you calculate what is the post acquisition finance costs of subsidiary? So now if I write here, out of 3000, 2000 is entirely post. Now So 1000 is accruing evenly over the year. 1000 is accruing evenly over the year. So now multiplied by 6 by 12 is the post, right? Now plus 2000 because this was entirely post. Because this was entirely post. So what is the amount? 2500. 2500 is the post acquisition finance costs, right? Now what is the group finance costs? The group finance cost is entire finance cost of parent 1800, that is 1800. Now post acquisition finance costs of subsidiary, that is 2500, minus intra group finance cost of 2000, minus intra group finance cost of 2000, which gives you a finance cost of 2300, a group finance cost. Is this question clear to all of you? Is this question clear to all of you? Tell me, guys. Is this question clear to all of you? Come on, tell me. If yes, then we will move towards. If yes, then we will move towards group P&L question in the ACCA practice platform. Harshita, Vishnupriya, Riya, Vartika, Trisha, Yashashwini, everyone, come on guys, tell me. Wonderful. Wonderful. So now let's move towards the group P&L part. Let's move towards the group P&L part. Okay. Now for that, let me open the ACCA practice platform for you guys. Just give me a minute. Can you see the screen? Can you see the screen? I will come at the corner. I will also come in the corner. A small person, a very small image of mine will also come in the corner so that you can see me. So that at least you can see me. Okay. Now we will open ACCA practice platform, which is already open in the screen. Can you see ACCA practice platform, guys? Tell me. Can you see ACCA practice platform? Can you see ACCA practice platform? Now, what we have to do? We have to go. Just a minute. I will increase the font size for you guys. Now, is it clearly visible? Now, is it clearly visible to all of you? Okay. So now we will go to financial reporting paper. We will go to financial reporting paper. In the financial reporting paper, we will go to ACCA official resources. Now, okay, before I start discussing, today I have made up a video for last 10 days strategy. Did you watch that? You watched that video? I have made a video on last 10 days strategy. Okay. So in that video, I am talking about the ACCA resources. So now how many papers are there? See, how many papers are there in ACCA practice platform? Past paper, if you talk about 1, 2, 3, 4, 5, 6 past papers. Now, then practice exams, how many? 1, 2, 3. So 6 plus 3, 9. Specimen exam, how much? 1. 10 exams. 10 exams are there, right? So 10 exams, you have to focus on this much only. You have to focus this much. You have to focus on this much now. Okay, you have to focus on practice. Now, so now we will be going to ACCA FR pre-June 2024 mock exam. Right? Now, I have already assigned to myself. Now, if I go on this one, So shall I start the exam? Tell me. Shall I start the exam? I have not yet started. Shall I start the exam? Okay, let's start it off. So these are the some guidance given in the exam, okay, which I will recommend all of you to read it once. Now we are going on directly to section C, question number 31. I'm not solving A and B. I'm not solving A and B. I'm going directly to question number 31. Vishnupriya, if you have not watched the last 10 days strategy, I will recommend you to watch it after the session. Okay, I will recommend you to watch it after the session. All of you have to watch it after the session. Okay, now, so this is the question on group P&L. This is the question on group P&L. Can you see the question? Tell me. Can you see the question? Tell me. Okay. So now, what is the question? On 1st January 2003, Persistent Pharma acquired 80% of the equity share capital of Smart Pharma. The share capital of Smart Pharma consisted of this much shares. Persistent Pharma settled the consideration of by issue of 2 new shares in exchange for every 5 shares it acquired. A further consideration was payable on 31st December. So this is deferred consideration. This is share exchange. On date of acquisition, the fair value of per share of pharma company is this much, and Smart Pharma is this much. Cost of capital is this much. Okay. Now P&L of Persistent Pharma and Smart Pharma is given. Now it's asking for the following adjustment is given. So basically on 1st January 2004, the Smart Pharma net assets is given. So basically fair value adjustment part is given. Now fair value adjustment part is given. Now policy of Persistent Pharma to value non-controlling interest at fair value. On 1st October 2002, the retained earnings of Smart Pharma is this much. Now during the post-acquisition period, Smart Pharma has sold. So intra-group trading is there. Persistent Pharma, the parent company, has issued some compound financial instruments. Discount factor is given. Goodwill should be impaired by 25% and profits accrue evenly throughout the year. Now, what is the requirement? What is the requirement? So, first requirement is to calculate the goodwill on date of acquisition. Second requirement is to prepare console P&L. Third requirement is to analyze the non-controlling interest using the 2 methods, that is fair value method and proportionate share method. And then you have to discuss the initial calculation and subsequent treatment of goodwill, okay, using the proportionate share method and fair value method of NCI. Okay, basically you have to give the gyan here, you have to give some gyan here, you have to give some logic here. That's what. Okay, so now see, this part C indicates me towards something. Ideally in the question they were asking only A and B so far, but coming this part C indicates that they can ask a logical question. Okay, SBR based question, a logical SBR based question as part of section C, where you have to write some logic, This question you will be able to opt if and only if you have studied things logically, you have understood the why behind every concept. Okay, if you have not understood the why behind every concept, it might be a challenge to appear for this question, but don't worry, I am here, I will help you out how exactly to write these type of questions. So don't worry. Now goodwill. So first of all, goodwill. So let's write here working now solution 1. Okay, So first of all, investments. Now, applying own figure rule, you have to ensure that you are giving all the calculations in properly. You are explaining all the calculations properly. Okay, no shortcuts, no shortcuts. All the calculations, explain it properly. On 1st January 2003, pharma company acquired 80% of the equity share capital of Smart Pharma. So now understand, what is the number of shares Smart Pharma has? 7 million. Writing the answer in thousands. Okay, calculating it in thousands. Why? Because the P&L is also prepared in thousands. If you can see statement of profit loss for the year in 30th September 2003 in thousands. So I will also prepare it in thousands. So investment is 7,000. Okay, now I have acquired how much? 80%. I have acquired how much? 80%. This is what I have acquired. This is what I have acquired. Now, how much I have to issue? 2 for every 5 acquired. So multiplied by 2 by 5. Multiplied by 2 by 5. Okay. Now, this is what I have given. Now, what is the value per share? What is the value per share of? Now tell me, whose fair value will take? Persistent company or Smart Pharma? So now this number of shares is the number of shares which Persistent Pharma will issue to Smart Pharma, means which parent company will issue to subsidiary company, because parent company has acquired 5600 shares of subsidiary company. Now 5600 into 2 by 5 is what parent company is giving to subsidiary company as a purchase consideration. So we have to multiply the fair value of parent company, fair value per share of parent company. So what is the fair value per share? Into 6.5. Why is this not working? Okay. Now, this is the value of investments. Okay. Now, what is it further saying? Okay, this is not the value of investment actually. Just a minute. Okay. This is the value of share exchange. Okay. Now, you can write here, this is the fair value of share exchange. Now, what is the present value of deferred consideration? What is the present value of deferred consideration? What is the present value? First of all, tell me that. What is the present value? What is the present value? So present, just a minute. I'll do some Control X. Present value of deferred consideration, how much? So again, right, what is the, it says you have to pay $3 per share acquired. So how many shares you have acquired? 7,000 ka 80% is what you have acquired. Now multiplied by 3 per share you will pay. Now, but when are you going to pay? On 31st December 2004. Now what is the today? What is the date of acquisition? 1st January 2003. So entire 2003, entire 2004 means I will pay after 2 years. Fixed amount of money after a fixed period of time, and the payment is certain. So it is deferred consideration, which we will recognize at its present value. So now we have to take the present value factor. So what is the present value factor? From here, for 10%, 10% after 2 years, 10% after 2 years is 0.826 into 0.826. Okay, now further, so what is the value of investments? The value of investment is equals to sum equals to sum. Okay, this is the value of investments. Now, what is the value of NCI? Fair value of NCI, because the NCI was at fair value. Fair value of NCI. What is the fair value of NCI? The fair value of NCI is equals to 7,000 is the total number of shares. Now, 80% is acquired by the parent company, so NCI will have 20%. NCI will have 20%. So be careful. Be careful. There is no specific reason. I have just added because later on when I will prepare console P&L, I will need B and C to write SFS of parent, SFS of subsidiary, then D will be for adjustments. So adjustments column should be broader. So for considering that point, I have added it off. Otherwise, there is no such need. Okay, there is no such need. Even if you're not doing it off, it's completely fine. It's completely fine. It's completely fine. Okay. Just for my ease, I have done that. For my ease, I have done that. Okay. Now NCI is 20%. Now what is the fair value per share of subsidiary? Fair value per share of subsidiary. What is the fair value per share of subsidiary? 4 into 4. So just Control C. Okay, now what? Less, minus, less. What is the fair value of net assets on date of acquisition? On date of acquisition, what is the fair value of net assets? So now, what is the fair value of net assets on date of acquisition? So let's write it off here. So first is come here, share capital. Share capital is 7,000 of subsidiary. Now it says the this is the okay. Now let's read the question further. What is the date of acquisition? 1st January 2003. Okay, fine. It says retained earnings on first. Okay, right here, retained earnings on 1st October 20x2 is how much? 12 million. That is 12,000. Now then, what is the profit? From 1st October x2 to 1st January x3. That is till date of acquisition. What is the profit earned? So that is equals to how much? What is the profit? What is the profit given? See here, 4065 is the profit earned by Smart Pharma. Subsidiary has earned a profit of 4,000. So let's write here is equals to 4065. 4065. Now October, November, December, 3 months. So into 3 by 12. So this is the profit earned. Now what is the net asset? So let's write here is equals to minus sum this much. Okay, now this is the carrying amount of net assets, but now you have to do the fair value adjustment also. So coming to adjustment number 1, a fair item of plant and plant had a fair value of this much in excess of the carrying amount. So let's write here fair value adjustment. Fair value adjustment. Now you write here plant is 4,000. Then what? B, these changes are not recorded by Smart Pharma. Okay, fine. There's a contingent liability of 250 which had a fair value of 125,000. So I told if the subsidiary has a contingent liability, you will record in the group FS at its fair value on date of acquisition, which is 125,000. So you'll write here contingent liability. Contingent liability. So it will be minus 125. Right. So now what is the fair value of net assets? Is equals to minus sum. So this is 23891. 23891. So now what is the value of goodwill on date of acquisition? On date of acquisition, that is 1st January x3. What is the value? Is equals to sum. $10146. Bold. Is that clear, everyone? Is that clear, everyone? Now it says during the year goodwill has been impaired by how much? 25%. So let's write here less impairment. How much is equals to this much multiplied by 0.25 is this much. So now what is the goodwill? Control C, Control V. What is the value of goodwill on? What is the year in 30th September 2003 if I'm not wrong? 30th September 2003, yes. So this is how much? $7,609. Control B pulled. Is it clear, everyone? Come on, guys, tell me, is it clear, everyone, till here? Okay, now. So we have solved the first requirement. We have done the first requirement, 4 marks, easy marks, 4 easy marks. Now what we will do, we will go to the second requirement, that is group P&L. So let's write here group P&L and OCI. Okay, now right here for the year ended 30th September X3. This is requirement number 2. Excess depreciation adjustment. Vartika, why do you think excess depreciation adjustment will be done in the goodwill calculation? Excess depreciation adjustment is done in the post acquisition part. But will that impact goodwill? Will that impact goodwill, Vartika? Will that impact goodwill? No, right? It won't impact my goodwill. It won't impact my goodwill. So that's why I have not done it here. That's why I have not done it here. Okay. Now when I prepare P&L, definitely I'll adjust everything. Okay. So let's first of all let's draw the performa P&L. Let's draw the performa P&L. So it will be for P. It will be for S. It will be for adjustments. It will be for group P&L. Bold. Okay, now, so first of all, let's draw the pro forma revenue, cost of sales, okay, gross profit, then S and D cost, selling and distribution costs, then okay, then admin costs, then finance costs, then investment income, then P profit before tax, then tax expense, then profit after tax. Okay, now what is the amount of B it is 45,000, it is 27,000, it is minus 24750, it is minus 18900. Selling distribution cost is minus 1115 minus 1325 minus 2650 minus 1660. Finance cost is minus 300 is equals to 600. Profit before tax, look at tax expenses, how much? Minus 2285 minus 1050 minus 1050. Okay, now so let us calculate finance cost. This is 0, this is 0. Okay, let's calculate the totals is equals to sum Control C, Control V, Control V. Profit before tax equals to sum. Control C, Control V, Control V. Profit after tax equals to sum. Control C, Control V, Control V. So this is the just the pro forma P&L I have drawn without any adjustments. Now we have to start doing the adjustments one by one. We will go through the question from top to bottom and we will keep on making all the adjustments. Now on 1st January we have acquired and we are preparing this month. So now please keep in mind that we have to do multiplied by 9 by 12 for this one. Okay, we have to do it for this one, multiplied by 9 by 12, time adjustment. We have to do time adjustment. But now tell me, the subsidiary we have acquired 80%. So will I take 80% of the entire P&L or I will take 100%? Tell me, will I take 80% of the entire P&L or I will take 100%? Will I take 80% of the entire P&L or will I take 100%? Come on guys, tell me. Will I take 80% of the entire P&L or will I take 100%? I will take 100%. I will take 100% because 100% of the P&L items is controlled by me, but not owned by me. That's why at the end, I will show what is owned by me and what is owned by NCI. Okay. Now, so what is the adjustment? Now, let's see one by one. Acquired 80%, no adjustment in the group P&L. Okay, so this is done. So here it's no adjustment. Yeah, further consideration, deferred consideration. So deferred consideration will definitely have an unwinding impact. So unwinding impact means it will increase my finance costs. So now you will have to add to the finance cost. So what will be added to the finance costs? Let's come here. 13877. So let's write here. I will write as part of working note. I will write here. Working note number 1. Not here. Working note number 1. Unwinding of deferred consideration. So what is the amount? It is equals to 13877 into 0.01. But this is for the entire year. But you have to take only for the 9 months into 9 by 12. Into 9 by 12. 1041 is the finance cost. So let's write here in the finance costs. Since it is minus, I will write here minus 1041. Okay, deferred consideration. Minus 1041 deferred consideration. Is that clear, everyone? Okay, so first is clear. Then this is done. No other adjustment. So first paragraph is done, sorted. We have taken the pro forma. Now first adjustment, PPE fair value adjustment. So we will have to account for the excess depreciation. So excess depreciation will add to the cost of sales. Add to the cost of sales means since it is minus, adding means also I will do minus. But what is the amount of excess depreciation? So let's write here excess depreciation. What is the amount of excess depreciation? Working note number 2. Excess depreciation will be equals to how much? Excess depreciation will be equals to how much? So what is the fair value adjustment? 4,000. Okay, now what is the life? 4 years. So this is the excess depreciation per year, but we have to charge it for 9 months. So into 9 by 12. So what is the amount? It is 750. So I will do I will have to add, so I will write here minus 750 excess depreciation. Okay, now first is done. Second, there is no, okay, now contingent liability, there is no, because we have already adjusted the date of acquisition, there is no further adjustment to be done. True is NCI fair value, okay, fine. Retained earnings, okay, fine. Now fourth point, working note number 3, unrealized profit. Now what is saying? Who has sold to whom? Smart Pharma has, okay, subsidiary has sold to the parent 250,000 per month. Okay, now so 250,000 per month is how much? 250,000 is per month is how much? So working note number 3 is, you can write here intra-group trading. Okay, now what is the total amount? What is the total amount of intra-group trading? 250,000 is equals to 250,000 per month multiplied by 9 month, right? It is 2250. So what I will do for 2250, I will reduce from both revenue and cost of sales. I will reduce from both revenue and cost of sales. Okay, you can write here intra group, intra. Okay, now reduce from cost of sales means I will do plus here. I will do plus in cost of sales means reduce. Okay, so be very careful in the exam. Be very careful in the exam for the sign. This is again an area where you can make a mistake, guys. Now, so now unrealized profit. Unrealized profit. What is the amount of unrealized profit? What is the amount of unrealized profit? What is the amount of unrealized profit? So it says goods worth 300,000 were included in the inventory. So 300 into what is the profit margin? 25% margin. It is margin. So I will just take 25%. I will not do 25 by 125. It is 75. So this I will add to the cost of sales. This I will add to the cost of sales means I will do minus sign. Add means minus sign. Cost of sales add means minus signs. Minus 75 unrealized profit. Done. Now this adjustment number 4 is also done. Adjustment number 5 is what? Persistent Pharma has, okay, parent company has issued some compound financial instruments. So working note number 4. Working note number 4. Okay, convertible loan notes. Now it says what? Has issued $3,000, $3,000, 1,005% convertible loan notes. Now what I have told in the class for the convertible loan notes, what I have told? So I have told clearly in the class that if it is compulsorily convertible to fixed number of equity shares, compulsorily convertible to fixed number of equity shares, then it is equity. Otherwise it is financial liability. Now for the principal part, tell me, for the principal part, it is just saying it is convertible. Is it saying compulsorily? No. Is it giving fixed number or variable number? No. So what happens? Principal part is financial liability. Interest part is also financial liability, but the conversion right part is equity. So we have to first of all find the value of the financial liability instrument. Okay, present value of principal part, present value of interest. Okay, present value of principal is how much? 3,000 is equals to 3,000 in multiplied by what is the present value factor at the rate of 7% for 5 years. 7% for 5 years is 0.713. 0.713 is this much. Now interest is how much? 3,000 का 0.05%, 3,000 का 0.05%. Now into annuity factor of 7% for 5 years. Is it given in the question? No. So let's find it off. 1.07 equal divided equals to for 1, 2, 3, 4, 5 GT is 4.1. Is 4.1 multiplied by 4.1 is how much? 615. So this is the value of FL component. This is the value of FL component. So it is equals to this plus this is the FL component. So what should be the finance costs? What should be the finance costs? So finance cost will be is equals to this multiplied by 0.07 into when I have issued October 20x2. And this is for the entire year, right? This is for the entire year, right? So no into this is the only amount, right? Now finance cost to be recognized. This is the finance cost to be recognized. Correct finance costs. Okay. Now what is the finance costs recognized? What is the finance cost recognized? It is equals to minus 3,000 ka 5% we have recognized the finance cost. The question is saying, see here, question, read the question. It says what? Persistent Pharma has recorded the liability at par value, that is 3,000, and recognized interest at 5%. So 3,000 ka 5% is what? Not this one. Is 150 they have recognized. So what is the finance costs to be recognized? finance costs to be recognized is equals to how much? 43. So let's recognize that. Let's recognize that 43. Okay, 43 minus. We have to increase finance cost, means I will do minus. Because 0.7% is the rate of interest. 7% is the rate of interest, Harshita. 43 is okay, compound financial instrument. Compound financial instrument. Why are we multiplying? Because this is the, I told yesterday, right? जहां जहां अनवाइंड, जहां जहां प्रेजेंट वैल्यू होगा वहां वहां अनवाइंडिंग होगा। मैंने ऐसा बोला था कल, मैंने ऐसा बोला था कल क्या? जहां जहां प्रेजेंट वैल्यू होगा वहां वहां अनवाइंडिंग होकर फाइनेंस कॉस्ट आएगा। तो यहाँ पे प्रेजेंट वैल्यू है ना 2754, तो इसको अनवाइंडिंग करेंगे, फाइनेंस कॉस्ट रिकॉर्ड करेंगे। तो इसका अनवाइंडिंग करके फाइनेंस कॉस्ट आया कितना? 193। उसने फाइनेंस कॉस्ट रिकॉर्ड कितना किया? 150। सो व्हाट इज द एक्सेस फाइनेंस कॉस्ट दैट वी हैव टू रिकॉर्ड? 43। So done. Goodwill is impaired by 25%. Goodwill impairment we have already calculated. What is the amount of goodwill impairment? What is the amount of 2536? We have to add it to admin expense. Admin expense. So let's add here minus 2536 goodwill impairment. Now done. Sorted. हो गया. Come on, group P&L. Let's prepare. So it is equals to this plus this into 9 by 12. Done. Now is equals to this plus this multiplied by 9 by 12 minus 750 plus 2250 minus 75. Done. Now here it is equals to this plus this multiplied by 9 by 12. Done. Now he is equals to this plus this multiplied by 9 by 12. ठीक है, माइनस 2536। डन. इट इज इक्वल टू दिस माइनस 1041 माइनस 43। डन. इट इज इक्वल टू दिस। डन. सो नाउ इट इज इक्वल टू दिस प्लस दिस इंटू 9 बाय 12। डन. One minute, why it is coming loss? Tell me, is that clear everyone? Is that clear everyone? Come on guys, tell me. Just give me a minute. Is it clear to everyone till here? Why 600 into 9 by 12? 600 is the for the parent, right? Investment income of the parent for 600. Is there any loan given or something of that sort? Is there any loan given or something of that sort? I don't think so, but still I will check it off. No. Consideration was payable was 31. Fine. Investment income is okay. Fine. Not recorded. Non-controlling interest done. Done. Yes. Fine. No. We have done the calculation correctly. Have we done the calculation correctly? Yes. एक minute, just a minute. What is they have taken? I think there is some mistake. Because of this, they have taken the formula differently or what? 45,000. Okay. That's 2250 minus 2250, 63,000. I don't know why, because in the book answer they have written it something different. In the book's answer they have written it something different, but the process what we have followed is correct. So I think the answer given in the suggested answer, the answer given in the suggested answer is wrong, is what I am assuming now. Because they are telling the revenue is 63,000. It cannot be 63,000, right? Or we have done some mistake. Or we have done some calculation mistake. Check. We have not adjusted 2250. 2250 is not adjusted. Okay. Here we have adjusted properly everything. Yes, we have adjusted properly everything. Now is it clear, correct everyone? Yes, it is correct now. Okay, might be because we forgot to adjust it this one. Okay, done. Everything is correct. Investment income. What about investment income, Harsita? Tell me, what about investment income? Is there any adjustment? No, I can't find any adjustment about his investment income. So it will come as it is. It will come as it is. It will come as it is. Investment income will come as it is. Okay. If the question would have said a subsidiary company has given a dividend, yes, we would have adjusted. We would have adjusted. But is the question saying that subsidiary company has given the dividend anywhere? Is the question saying that? Tell me. Is the question saying that subsidiary company has given a dividend? Retained earning is this much 1st October, and no other thing is mentioned. No, so nothing is mentioned. So 600 will come as it is. Okay, now this is the group P&L, but now still one thing is pending. The allocation of profits. Allocation of profits to owners of parent and to non-controlling interest. And non-controlling interest, allocation of profits. So let's write working note again. Working note number 5. Working note number 5. Now it will be allocation of profits to NCI. Allocation of profits to NCI. Okay. Now what is the amount of profit? So now tell me, what is the post acquisition profit of NCI? What is the post acquisition profit of NCI? It is equals to 4065 into 9 by 12. This is the post acquisition profits of NCI. This is the post acquisition profit of NCI. Now what are the adjustments made to the profit of NCI? So first adjustment is excess depreciation. Excess depreciation on account of fair value adjustment. Then adjustment will be for goodwill impairment. Goodwill impairment, and then adjustment will be for unrealized profit. These are the 3 adjustments. What is the excess depreciation? It is 750. What is the unrealized profit? 75. What is the goodwill impairment? Minus 2536. I believe these are the amounts. I have not seen the amounts, but I believe these are the amounts. I'm not wrong. 750, 75. Very good. And impairment loss is 2536. So correct. So now what is the adjusted profit? What is the adjusted profit? Equals to sum. This much, negative 312. Oh my god. Okay, then what is the share of NCI? Share of NCI will be 20%, right? So equals to this multiplied by 0.2 is 62 is the negative 62 is the share of NCI. So let's write here out of this negative 62, a loss of 62 will be taken by NCI, and the parents will take a profit of this minus NC. What is the profit attributable to this one? So this is the how we will allocate it off. This is how we will allocate it off. Is that clear, everyone? Is that clear, everyone? Come on, guys, tell me. Is that clear, everyone? Now, so this is all about your group P and L. This is all about your group P and L. Now the question is also asking for the third part. When valuing NCI at acquisition under IFRS 3 good business combination, there are two methods permitted: fair value and proportionate share method. Okay, discuss how the initial and the subsequent treatment of goodwill arising on acquisition of Smart Pharma would have differed had the NCI been measured at proportionate share method of identifiable. Okay, now. So let's calculate goodwill if NCI is at proportionate share method. So let's do that. Let's calculate it. So what I will do, I will copy the entire goodwill calculation. I will copy the entire goodwill calculation. Control C, and I will paste it off here. And I will paste it off here. Yes. And I will write solution number 3. Solution number 3. Not here, I will write here solution number 3. Okay, now, so in solution number 3, what I will write here is, now investments will remain as it is. Now NCI value will change. Now what will the NCI value? It will be equals to this multiplied by 0.2. Okay, it will be 4778. Now what will be the amount of goodwill? 9234. Impairment loss will be this much. Goodwill impairment will be this much. Now it is okay till here. But what happens now? This impairment loss of 2331, will that be allocated to parent and NCI both? Will that be allocated to parent and NCI both? Tell me. Will that be allocated to parent and NCI both? No, it will be only and only for the parent. It will be only and only for the parent. It will be only and only for the parent. Now if you have to calculate allocation of profit to NCI, then what will the treatment look like? I will show you that also. If you have to calculate the profit attributable to NCI in this case, how will it look like? So definitely this will be equal same, but goodwill impairment won't come here. Only this much will come up here. Only this much will come up here. Only this much will come up here. This is the share of NCI. Is that clear, everyone? Is that clear, everyone? Okay, now let us evaluate our answer with the suggested answers. Do you want to evaluate your answer with the suggested answer? Let us do that. Okay, so let us submit next. This question we will be discussing tomorrow. Tomorrow we'll discuss this question. Okay, so again, next. Okay, we have to scroll down the window. We have to scroll down the window. Next. Then end exam. Are you sure you want to end the exam? Yes, we want to end the exam. Yes. Don't worry, I have saved the answer in the Excel file. Okay, I have saved the answer in the Excel file so that we can I can share the answers with you guys. Pre-June 2024 exam marking. So let's do the self-evaluation. Now, question number 31. This is a sample answer. So now we can compare it side by side also. Our answer versus what is the suggested answer. We can compare it side by side. Now see, zoom in. Okay, we do have an option for zooming. Yes. First of all, goodwill we calculate 10146 and 7609. Tell me yes or no. Let's compare our answer also. Let's compare our answer also. Goodwill, what is that we have calculated? What is that we have calculated? Oh, no worries. I will show you the answer from here. You can see the answer from here. I knew something like this will happen in ACCA practice platform, but that's the reason I saved it off our answer here. See, what is the goodwill that we have calculated? 10146 is the goodwill that we have calculated. 10146 is the answer. Okay, now subsequently, after goodwill impairment 7609, and we have also calculated, where is that, 7609. So our answer is also matching with the suggested answer. So we are fine till here. In console P&L, now what is happening? In console P&L, now see our console P&L and the console P&L of the exam. So revenue, our revenue is 63,000. You have to see this column. I will highlight it off. I will highlight this column. Okay, now you will be able to see it better. Okay, now revenue 63,000, our revenue 63,000. Revenue, cost of sales is 37,500. Our revenue is also, cost of sales is also same. Gross profit matching, sales and distribution expense matching, admin expense matching, finance cost matching. Investment income they have not considered. Why? Let me see. I have considered it, but they have not considered. Income tax matching. Profit attributable to the NCI 62, they are writing 63, so that one is an kind of rounding of it, that is fine. Okay, but again, honors. So basically the difference in our answer and the suggested answer is due to investment income. Let's see why they have not considered investment income in their working. We might find the reason for the same. Ideally, I believe I am correct, but still, let's see. Is there any justification given in the suggested answers? Is there any justification given? They have given the justification for what? Fair value adjustment. Okay, fine. I understand the same. Unrealized profit. Okay, I understand the same. I understand the same. Unrealized profit. I understand the same. Depreciation on fair value adjustment. I understand the same. So this is a mistake done in the examiner's answer. This is a mistake done. So they have forgotten to write the investment income. This is a mistake done in the suggested answer. This is a mistake done in the suggested answer. Okay. So otherwise we are correct. Now further it is saying one third part also of the answer. Third part of the answer. Third part of the answer. Goodwill calculation as per proportionate share method. So now they are calculating 9324. 9324. And how much did we calculate? Just see for the third part. For the third part, how much did we calculate? 9324. See, 9324. 9324. We have calculated 9324, right? So our answer is matching. Our answer is matching. Okay, our answer is matching. So this is it. This is it. This is it. Okay. So, but you have to write in the exam some logical discussions that since goodwill, so, NCI is a proportionate share method. Goodwill is partial goodwill. That is, goodwill is only and only for the parent, and hence any impairment loss that arises will also be allocated only to the parent and not to the NCI. This is the difference between. This is the difference between calculation of goodwill when NCI is at proportionate share method and when NCI is at fair value method. So this is how you have to write your answers. Tell me, is that clear, everyone? Is that clear, everyone? Come on, guys, tell me. So I believe I have discussed from end to end. I have discussed the question from end to end. You have got a fair understanding of how to use the ACCA practice platform also with this discussion. I believe so. So I'm closing down this one. I'm closing down ACCA practice platform and I'm coming back to my screen. Just hold on a minute. Don't go. Okay. Will not adjust impairment in part C while calculating share of NCI? No, because since NCI is at proportionate share method, goodwill impairment is only for the parent. So we will not impact that NCI there. Will not impact NCI in that case. Okay. Okay, Harshita. Now, so this is what we have discussed today. Tomorrow we will be discussing interpretation. Okay. Again, a wonderful question on interpretation this time. So we'll discuss that. And yes, that's all from your marathon sessions of SBR for FR. Okay. Now I'm thinking about SBR because SBR sessions are now will be starting from day after tomorrow. Okay, so that's all for today, guys. I hope you enjoyed the session. If you are new to this channel, please subscribe to the channel, like this video, share it with your friends, and do not forget to give a feedback in the comment box. Okay, after the session ends, please give a feedback in the comment box, whether positive or negative, whatever it is, but please give a feedback. That's all for the day, guys. Thank you. Bye bye.